Hello and welcome back to another episode of Baat. The markets are at an all-time high and us investors have a lot of questions that we would like answered. So today I have with us Mr. Sachin Jain, the head of mutual fund research at ICICI Securities. He's also the man behind our one-click mutual funds. Thank you so much for being here, sir, today.
Yeah, thank you, Shashwat.
So let's dive right in. The markets are at an all-time high. What is your outlook on the market?
Yeah, so I think that's interesting. So, let's just start with, in terms of the market outlook, we are constructive on markets and we are advising investors to buy on dips. Now, to come with there are few points which are positive in the markets and there are few points which are slightly more on the negative side of it. So, to start on the positive side, currently the higher earnings growth and the quality of earnings is very, very strong. So, currently the Nifty EPS for FY25 is expected at around 1080 rupees, just around 1100 rupees. So we are trading somewhere around 18 times 1 year forward on a PE basis. Historically, we have traded in the range of 16 to 19 times. So currently at 18 times, we are slightly at the higher end of the market range in terms of valuations, but we are not very out of the whack as well. So slightly expensive, but not very, very expensive. Secondly, technically the market is looking very strong. If you look at the flows, how the technicals of the markets are favoring, they are looking very bullish. They are not giving any signs of being bearish on the markets. Thirdly, there is a very strong liquidity flows which is there in the markets. We are seeing a strong domestic flows which are continuously coming into the markets. In fact, the foreign flows have also turned positive since the start of this calendar year. So from a liquidity aspect, the market is looking very, very strong. And the fourth factor, very important factor, is the TINA factor, which is there is no alternative. If you look at the debt returns or the fixed income return, the bank FDs, they all are giving less than 6-7% return. So there is no other alternative for the markets, be it for the domestic investors and be it for the global investors. So from a market positioning perspective, from a capital allocation perspective, you need to have an equity as an asset class. Even global investors are finding it difficult, but there is no other way than to invest in equities. So 4 factors: higher earnings growth, technically the markets are looking strong, liquidity is very strong, and 4th, TINA factor favoring equities. On a negative side, on the flip side of it, a couple of points if I can just highlight is, as I just mentioned about the valuation, slightly on the higher side of the valuations, be it in terms of PE, price to book, market cap to GDP ratio, which generally we generally as an analyst talk about it, slightly on the higher side, but not very out of the whack. And secondly, there's a risk of global slowdown. We all know the global wars are happening between Russia, Ukraine, what we are seeing, and just now the recent about the few global geopolitical concerns which are being raised. So there is a concern about global slowdown, and especially in the wake of how much the US Fed has hiked the interest rates. So there is a risk of a global slowdown. So these two could be the major risk, but we have around 3 to 4 positive points in terms of the market's outlook. So what should be the allocation strategy? I'm sure that would be the main important point about the investors which need to be asked. So what we are recommending currently is avoid lump sum and invest through SIPs. And in terms of lump sum, buy on dips. So what we are saying is regularly investing through SIPs and buy on dips. So these are the 2 clear allocation strategy what we are recommending to our investors right now.
So you suggested the buy on dip strategy. Could you elaborate a little bit on it for our investors?
Yes, I think so. That's very important. Generally we as an analyst or the market participants always advise, buy on dips, buy on market correction. But generally no one tries to answer how much is the dip, or how much correction the investor should invest in. That's a very practical question which we also come across is. So we have just tried to analyze historically how the markets have behaved in terms of the market correction. So if you can just refer to the slide also, in general, the large caps generally fall in the range of 10 to 16% every year, at least 1 to 3 times. And on an average, the fall is around 10 to 12%. So Nifty 50 generally falls in the range of 10 to 16% every year, and the average fall is around 10 to 12%. If we take out an example of Nifty Midcap 150 index, generally the midcap index falls in the range of 10% to 25%. And this fall also occurs anywhere between 1 time to 3 times. So midcap generally falls in the range of 10 to 25% with an average fall of around 17 odd %. With respect to small cap, we did this exercise in terms of Nifty small cap 100 index. Nifty small cap 100 index falls in the range of 10% to 35%, with an average fall of around 20%. And this falls also is around varies between 1 time to 4 times. So it also depends how much the small cap has run up in the last few years, last 2 years, last 3 years. So if the market has run up significantly, the small cap index, it may fall 4 times also, and it may fall towards 20%, 25%, 30% also. So broadly speaking, if I have to just give a broad sense allocation, Nifty 50 can fall in the range of 10 to 12% every year, maybe in 1 time, 2 times. Mid cap index can fall in the range of 10% to 25%. Small cap index can fall in the range of 10% to 35%. So this is the kind of a dip we are referring to. So any investor, so for example, buying on dips in Nifty is likely to fall in the range of around 10 to 12%. So we cannot wait as an investor to buy, to let the Nifty fall by 12%. So as an investor, we can start investing by whenever the Nifty is down around 6%, 7%, 8% from its recent highs. And we can start investing until till it falls. Basically subsequent investing at every fall. Similarly, in the mid cap and the small cap, we can just start investing whenever the Nifty small cap index is down by around say 10%, 15%, and then keep on accumulating at every subsequent fall. So this could be a better strategy in terms of lump sum investing, because ultimately what we are doing, see, we have to do regular investing. That's the core of investing, regular investing, SIP investing. Buy on dips, 10, 12, 15%, 20% fall, depending upon which market cap you are investing. So those dips, we investors should utilize to put lump sum amount, additional lump sum amount apart from the regular SIP.
Okay. So here, instead of looking for the absolute bottom, we start buying as the market is going down.
Absolutely, absolutely. Just start investing whenever the market is down 7, 8%, 10%, and keep on investing at subsequent falls. So that's a more of an easy way of putting it across in terms of how much dip the investor should buy.
Absolutely. And now speaking of small caps in the last couple of years have had a really good run. But lately the mutual fund managers have been cautioning against small caps. So what is your view on this segment and your outlook on the performance of these small cap funds in the future?
Yes, again, so I know this is again a very common question which is being asked to us in terms of small caps. So in the small cap funds investing in general, we have been recommending small cap funds, mid cap funds in general. But if you look at it, the data, as you can also see, the earnings upgrade which has happened in the last 1 year or in the last 7, 8 months since the start of this calendar year, the Nifty 50, the index, the earnings have been upgraded by around 5% in last 2 quarters, whereas the Nifty small cap earnings have been upgraded by 21%. Whereas for similarly Nifty mid cap 100 index, the earnings have been upgraded by 16%. So the upgrades which has happened in a overall market, for large cap it is 5%, small cap it is 21%, and mid cap it is 16%. So we are clearly seeing that the earnings momentum is towards small cap and the broader indices. So if market is rewarding the small caps or the mid cap funds or the mid cap stocks, there is a reason behind it. There is a strong earnings growth and earnings momentum which is there in the markets. So earnings growth is anyway higher for the broader category, and even the upgrades are also higher for the mid cap and the small cap category. And that is the reason the small cap and the mid cap funds and the stocks have done well in the last 1 year, despite in general a lot of fund managers or a lot of market participants being cautioned about it or being talking about very cautiously. So earnings growth is the key for the markets, which is currently in favor of the small cap and the broader markets.
Okay, so from what I gather, the funds are doing really well. But whenever the market starts doing really well, we usually expect a correction in the near term. So what is your take on that?
Yes, so as an investor, we should always look at the broader outlook, how market performs. There are a lot of market gurus which tell us that market performs in cycles. Everything, even life, even everything related to everything is performs in cycles. If there's a up cycle, there's bound to be a down cycle. If you're happy, you're bound to be sad, maybe in a going forward. So investors need to be prepared of it. investors just need to have an broad understanding in terms of where we are currently in the market cycle and how historically the recent cycle, how strong it has been. So if you can just look at the data, from March 2003 to December 2007, there was a very strong market upcycle where the category average return of large caps funds was around 528% or just upward of around 500%. Whereas during the similar period 2003 to 2007, the category average return of mid cap and small cap was around 929% or upward of 900%. So 500%, 900%. In a down cycle, when the markets fell, large cap fell by around 50% odd, the small cap and the mid cap index fell by around 68%. The category average return of mid cap and small cap returns from January 2008 to March 2009. Again, because we fell, there was supposed to be an upcycle which happened from April 2009 to September 2010. Category average large cap return was 100%. Category average return of mid cap and small cap was 171% from April 2009 to September 2010. Then again the down cycle came, large cap delivered negative 23% return, small cap mid cap funds delivered minus 35% return from October 2010 to December 2011. Again from the down cycle we again recovered from Jain 2012 to December 2017. Large cap funds return was around 128%, small cap mid cap funds return was around 240 odd percent. Again, when we had seen such a positive return, we again fell from January 2018 to March 2020. The large cap funds delivered return of around minus 24%, small cap and mid caps delivered around minus 50% return. And the current cycle, which we have just seen from the post-COVID, the April 2020 to till September 2023, the current cycle, the large cap category average return is somewhere around 130%. The category average return of mid cap and small cap is around 240%. So this is how the market cycle behaves. When markets deliver up cycle returns, market is bound to deliver negative returns. And from a negative returns, market is bound to again come back and deliver positive returns. So this is how basically the cycle performs, and currently we are in that up cycle. Another important thing is, investors try to time the markets. So just to give you a perspective, if you look at it, 1 year before, 1.5 years before, as you were mentioning, a lot of fund managers also, a lot of market participants were cautioning investors to exit the markets, to lower their equity allocation. But let's just look at this. From April 20 to October 2021, October 2021 was the recent peak of Nifty. From there, the mid cap and the small cap funds have still given more than 50% return since then. So just imagine if you would have exited in October 2021, you would have missed out on the 50% additional return which the category average of mid cap and small caps have delivered. So why we say that, while investing at lows is important, not exiting early is also important. So if the investor would have exited 1 year before, he would have missed out on this additional 50% return which the mid cap and the small cap funds have delivered. Right. So just focus on market cycles and just focus on not exiting the market early also, apart from getting into the market at the bottom. So 3 important points: investing at bottom, investing on dips, take a macro view of market cycles, and not exiting out of the markets early. So these are the 3 mantras of successful investing and successful wealth creation.
Thank you so much for that, sir. So for retail investors like us, it's very hard to keep a track of all these trends. And even within these trends, it's very hard to make sure which fund is performing well, which is not. So a fantastic solution to that, and the man behind that is you, is our MF one-click baskets. So could you tell us what is MF one-click baskets and why one-click?
Yes, so why one-click? It's actually important. So, different fund managers perform in different market cycles. So most fund managers outperform in a specific period of time, and they outperform in a particular market cycle, then they underperform in a particular market cycle. So it is very difficult for an investors to preempt which cycle will perform well and going forward after they have themselves. So it is very important as an investor, as an analyst, to understand that if a particular market cycle has done well, for example, a growth investing style or a value investing style or a momentum value investing style. So these are different styles which generally market follows. So we have seen a lot of funds from growth style which were doing well from 2013 to 2019, and then they underperformed after that. Similarly, there were a lot of funds which were underperforming in the period from 2014-15 till 2019-20. Then they outperformed hence after 2020-21. So therefore, it is important to not invest based on historical returns. So the first point is, since different fund managers perform in different market cycles, it is important that we take a call on the fund managers and invest in the cycle or the funds which is likely to do well going forward, and not invest basis the historical cycle or the historical return which the fund has already done. So different fund managers perform in different cycles, and we need to preempt those funds and fund managers which is likely to do well going forward. So that is where the one click comes in. We generally try to avoid funds which have already done well significantly, which has already outperformed, and it may underperform going forward. So we are very cognizant, especially when a particular fund has already outperformed. In fact, our due diligence becomes double when a fund has already outperformed. It is counterintuitive to what general investors do, right? Investors generally invest in a fund which has already done well. Last 1 year ka best performing fund, last 2 year ka best performing fund, and they just invest in it. In fact, we take a more forward-looking approach in terms of which fund can do well in future. Secondly, or the thirdly, if I can say, it also helps, this one click helps investors to focus on allocation by reducing the selection risk. And since our endeavor on MF one click basket is to ensure that the stable performance is there, the consistent category average above category average performance is there, it eliminates the underperformance or the selection risk to a large extent. Investors may just focus on allocation, which is how much to invest and not where to invest. Because if investors are reasonably sure that they are not investing in an underperforming funds, they can allocate more. So our advice in general, or our approach in one click, is investors focus on allocation and not on selection, because we are taking care of that selection risk. And lastly, our whole objective of one click is to ensure that we do not invest in an underperforming fund. Because our experience has been that since investors invest in a best performing fund, historical best performing fund, more often than not that fund underperforms going forward. And our objective is to ensure that future underperformance is not there. So what we are trying to do, we are trying to eliminate the future bottom quartile underperformers, and by doing so, automatically more often than not, our mutual fund one click will be in the top quartile performer. So our whole objective is in every mutual fund MF one click basket to deliver returns which is above category average. So that's where that is why we are advising investors to invest in MF one click.
Right, absolutely, and I think it's a big deal that you take away the where to invest component of it, because that is the most intimidating for most investors. We're always fearful of whether it's the right place to invest or not. अब बस इतना देखना है कि कहाँ कितना पैसा डालना है.
Right.
You mentioned that we invest in funds that are going to outperform, but it's always a question mark, right? So is there anything that shows us that historically we have done this, and are there any specific baskets that you would want to talk about?
Yes, so we have a lot of baskets which cater to the specific requirements of investors. So just to give you an example, we have something called a blue chip wealth creators, which is our flagship large cap baskets. So this is a basket which is for investors who wants to invest in large cap funds. So if you just look at maybe the historical returns or how we have done it, our blue chip wealth creator basket has consistently outperformed the category average or even the benchmark. So if you look at the 1 year return or the since inception return, we have significantly outperformed the category average as well as the benchmark. If you look at it, just to give an example, so in the early 2022, when the market cycle turned and the style of investing turned, we shifted out of the funds like Axis or Canara Robeco funds to the funds like Nippon or a Kotak. So because we believe that that cycle may underperform going forward. In the early 2022, we took that call and we shifted from the funds like an Axis or a Canara or a UTI to funds like Nippon or an HDFC's or an ICICI's funds. So we shifted from those funds to Kotak's and the multi-cap or Kotak and the Nippon funds, and those funds then since then has outperformed. You also can look at it, there are a few funds from an AMCs like ICICI Prudential or Bandhan AMCs. We have consistently recommended those funds in the large cap basis. So those funds are more consistent performers and we have stick to those. There is also an example of Bandhan AMC which historically had not done well prior to say 2022 or 2021. That's where on an outlook basis approach and based on the discussion which we had with the fund managers and our internal house view, we took a call on introducing those Bandhan large cap funds into our blue chip wealth creator. And that's where the change has come. We took a approach of forward looking and exited few of the funds and introduced few of the funds while sticking to few of the consistent performing funds. So that was one of the reasons why our blue chip wealth creator basket has consistently outperformed. Coming to say our star performing funds, which is our more of a flagship basket. Star performing fund is more of a multi-cap basket. This fund again, if you look at it, we exited a UTI flexi cap fund in the early 2022 and we shifted to HDFC flexi cap fund. HDFC flexi cap fund prior to that was underperforming, but we took a call that a value style of investing or the portfolio positioning of the fund was such that those were more beaten down stocks, beaten down segments, beaten down sectors, and that had a more of a potential upside. So we shifted from say UTI flexi cap fund to HDFC flexi cap fund. So that was one big change which we did in our star performing fund, which is our more flagship funds basket, which is a multi-cap. It has 4 funds, which is 1 large cap, 1 mid cap, 1 flexi cap and 1 small cap funds. So this is a change which we did in our star performing fund. Similarly, if you look at the mid cap basket, we have a star mid cap funds basket. We shifted out of Axis funds, we shifted out of DSP funds, and we got into something like a Nippon growth fund or the Motilal mid cap fund recently. So we took that conscious call of exiting the funds which were which we believe may not do well, and we shifted into funds which we believe that could do well. Similarly is the small cap basket. We have something like a star small cap funds. In a small cap fund, it is even more important to follow a basket approach and also to ensure that you do not stuck in a fund, because an underperformance in a particular small cap fund can be significant. So if as an investor or as an analyst, if you are able to ensure that you are not in an underperforming fund, because an underperforming fund can underperform significantly, and if you can avoid that significant underperforming fund in your portfolio, ultimately you will be able to achieve above category average return. And that's where we have also tried. We have exited out of Axis small cap funds. We have and tried to be more into Franklin smaller companies fund, which prior to our recommendation was not doing well. But again, we look at more of a forward looking approach. We entered into something like a Franklin smaller companies fund. So those are the approach which we have adopted in terms of changing the fund, switching in and switching out of the fund. Few of the funds like HDFC small cap or a Nippon small cap, those are the few of the funds which are in our consistently which we have been recommending. And they, if you can look at it, they are more of a above category average performer consistently. So this is a kind of an approach, is what we are following in terms of changing the funds and remaining in the funds also. So these were the few of the examples of practical example of historically how we have managed our mutual fund one-click baskets.
And before I go and invest, is there anything else I should know about MF one-click baskets?
Yeah, so lastly, my only advice to investors is, just don't look at the historical return. In fact, historical return is a very bad indicator of future outperformance. And we have seen investor experience of particular fund return versus the investor's own experience is widely different. what the fund return is and what the investor return is quite different. We have seen a lot of articles coming every now and then that the fund might have delivered a 20% CAGR, but the investor return could be 16% CAGR or a 15% CAGR. Why? Because he has invested at a time when the fund had already done well. So don't look at the historical return. It's a very bad indicator of future return. Secondly, follow a basket approach, because we don't know which fund will do well, which fund will not do well. Thirdly, select funds based on the consistent track record of the fund managers, especially the fund managers which have seen multiple market cycles. We have in the industry, there are fund managers who have seen multiple market cycles. So stick to those fund managers. And lastly, if possible, take a more of a advised approach and just try to do more research in terms of the portfolio stocks which are there in the funds, which sector currently the fund is more overweight, more underweight, whether that sector has already done well or not done well, and take a more of an advised approach. Just do more research, qualitative research, and not just quantitative research. Just ask fund managers, ask analysts, do more research whether this fund is currently appropriately placed or not. If you do this kind of a basic research, I'm sure its wealth creation journey actually is very smooth. It's not as difficult as it is made out to be. Just avoid underperforming funds, just avoid, just a fund which are best performing fund, and just invest in a more, multi-cycle fund manager, consistent funds. And I'm sure there is no reason to believe that why a significant wealth creation will not happen. So from an investor's perspective.
Absolutely, that answers all of my questions, sir. So that is a lot of research, and someone like me could really benefit from all of this research. But how much is ICICI charging for this service, for all of this research?
So currently, happy to inform that currently it's free. It's absolutely, there are no charges for one click as of now.
That is fantastic to hear. Well, I'm right on my way to invest. It was a pleasure talking to you, sir. This was Mr. Sachin Jain. Thank you so much, sir.
Thank you.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.